If you've ever wondered, how do I pay myself for my LLC without setting off IRS alarm bells? Well, number one, you're not alone, and number two, you're in the right place. I'm Jeff Hampton, asset protection lawyer and founder of STR Law Guys. Today, we're taking the guesswork out of how to pay yourself from your LLC. Not only will we bust up some myths that tend to trip up new business owners, but we'll give you a step-by-step guide and process for how to pay yourself in your LLC. Plus, we'll cover when it might be time for you to switch to an S Corp in order to maximize your tax savings. Stick around, because getting this information could be a serious game changer for your tax savings and your financial future. First things first, let's clear the air on a widespread misconception. I've heard people say, forming an LLC will save me a ton in taxes. Well, here's the truth. It usually doesn't. An LLC, or a limited liability company, is an excellent place to start to provide you some asset protection for your assets. LLCs are a great way to separate your personal assets from your business assets. So in the event that your business goes south, it will help to protect your personal assets from being taken, whether it be in bankruptcy or in a lawsuit. But when it comes to taxes, the IRS will likely treat your LLC as what's known as a disregarded entity, unless you tell them otherwise. That means you're taxed just as a sole proprietorship or as a partnership, depending on how many partners you have. That means all the profits pass through to your personal tax return, and now not only are you responsible for your self-employment taxes, but also your federal and state income taxes. So the big question is, how do you get your money from your business into your personal pocket without tripping over any legal hurdles? Let's break it down. First, let's examine the owner's draw. Think of this as transferring money from your business piggy bank to your personal piggy bank. You can take an owner's draw whenever you want. There's no taxes withheld up front, there's no payroll process, and there's no W-2 involved. It's flexible and straightforward. But here's where you need to pay attention, because all of the profits that you make in your LLC, whether you pull them out for personal gain or you leave them in the LLC, they are now subject to both federal taxes as well as self-employment tax. And when I say self-employment tax, I'm talking about the 15.3% talking about Social Security and Medicare. This stuff can add up really quickly. But what if I told you there was a legal strategy to save you potentially thousands of dollars on those self-employment taxes? Sounds good, right? Well, here is where electing S corporation status can come into play. We'll get into that in just a moment, but first, let's make sure your LLC has been set up properly. Setting up an LLC is not just about filing some paperwork and calling it a day. There are crucial steps you need to follow in order to make sure your business is legally sound and primed for success. Number one, proper formation of your LLC. And I'm going to go through this list of items that we're going to discuss here. Number one, we're going to talk about filing your articles of organization. This is the foundational document that officially forms your LLC with the state. Number two, you then, after you file your founding documentation with the Secretary of State, you now need to obtain an EIN number. This employment identification number is from the IRS, and it essentially acts like a Social Security number for your business. Number three, and here's where many people get it wrong, you must draft an operating agreement for your LLC. There are many of these businesses that are out there that are forms companies that will allow you and help you to set up an LLC, but they will not draft an operating agreement. Let me be crystal clear. If you do not have a strong operating agreement for your LLC, this is the rules for the relationship for your business. And if you want actual asset protection, if you get hauled into court, the first thing the judge is going to want to look at is the actual operating agreement, because it is the rules and it sets the stage for any actual protection you might have if you end up being sued. Number two, separate your finances. It's very important to open a bank account with that EIN number you now have from the IRS. And one of the worst things you can possibly do is to mix any of your personal purchases with your business purchases. You must separate those two purchases, never commingle funds. It's one of the biggest no-nos to lose your asset protection. A dedicated business account helps to keep things clean and organized. And part of separating your business accounts from your personal accounts, you can also obtain a business credit card so that you can make those dedicated purchases for your business and make sure and protect yourself with a firewall so you don't commingle funds. Number three, you must have a mindset shift. Here's the problem. You may be used to operating your business like you do like a side hustle or just some side arm of your life. Can I tell you right now, you must now treat your business like a business. This is no longer a hobby. You must keep meticulous records. You need to save receipts. Make sure you document everything. In fact, it's at this stage, particularly if you are into rental real estate, maybe you have a short-term rental, maybe you have long-term rentals, whatever type of rental property you may have, it's at this point it makes sense to be looking to potentially invest in a bookkeeper, a real estate CPA, someone who can help you make sure you're organized so that you can put all this into place and keep it in place. Number 2, paying yourself from your LLC. Now that we have the LLC set up properly, here's the good stuff. It's time to get paid. With an owner's draw, you can transfer money from your business account to your personal account whenever you want to. There's no reason to schedule any of it. But make sure you keep track of these draws. Make sure you put them down in your bookkeeping because number 1, you're going to have to pay taxes on these draws. But number 2, you want to make sure you have accurate records so you know where your money was moved. As you then pay yourself from your LLC, it's time to start planning for taxes. A good rule of thumb is to set aside 25 to 30% of your net income to cover taxes. Another good move that many seasoned investors use is to set up a separate tax account, where as you do make these owner's draws and you pull that money out of your business account, you actually have a separate savings account where that specific money that's used to pay your tax liabilities will be found so that you don't get caught off guard. Oh, and by the way, if your business is actually making money, there's a very good chance the IRS is going to expect you to pay quarterly payments, not just once a year. So get ready for those quarterly tax payments and always consult with a CPA so that you're ready to meet these obligations. And don't forget to mark those dates because missing those estimated tax payment deadlines come with penalties and fines. Step number 3, it's time to consider S Corporation status. Here's where things get interesting. If your business is now starting to make at least typically around $40,000 to $50,000 a year in net income, it may be time for you to consider S Corporation status in order to save on those self-employment taxes. So what are the benefits of an S Corp? Well, number 1 are those tax savings. As an S Corp, you can pay yourself what is known as a reasonable salary, which would initially be subject to payroll taxes. But here's the good part. Any profits above that salary amount can now be taken as distributions and they are not subject to that same self-employment tax. For example, if your business makes a net $80,000 a year and you pay yourself a $50,000 salary, you can then pay the remaining $30,000 as an owner's distribution. This one step alone potentially saves you over $4,500 in self-employment taxes. So how do you elect an S Corporation status? You have to file an IRS Form 2553. You submit this to the IRS to elect S Corporation status for your LLC. Always check the IRS deadlines and make sure you get that filing in properly. And of course, it's always advisable to consult with a CPA to make sure you're doing this right. So I want you to visualize your income split up into 2 streams. On one side is the salary, the higher tax rate. And then on the other side are the owner's distributions, which there you save money on taxes. That is the power of an S Corp. Step number 4, paying yourself from an S Corporation. Now that you've elected to save money on your taxes with an S Corp, how do you actually pay yourself? Number 1, set a reasonable salary. When I say a reasonable salary, how do we know it's reasonable? Where your salary should reflect what someone in your position would receive fairly in an open market. But it's really important that you use documentation here to make sure and show, in the event you're audited, the IRS how you came to this conclusion. Maybe you're able to take a look at industry standards, hours worked, responsibilities. All of this is easy to come up with. Then it gets pretty easy. You know how much you're going to pay yourself every month as a salary, and then any profits above that salary you can now take at a distribution for an owner, and then it will be taxed at a much lower rate. And when I say lower rate, I don't mean federal income tax rate, I mean no self-employment taxes, which is where some of those serious savings can come in. But don't forget, in order to stay compliant, you need to process payroll for your salary, including your withholding. You must also file payroll reports. Many times the IRS will want to see you pay quarterly and annual filings like Form 941 and Form W-2 at the year end. And as always, bookkeeping is a premium here. In order to show you're in compliance, you have to keep good records. So consider hiring a bookkeeper or make sure you spend the time to get it done for yourself. Okay, so let's finish off here with some common mistakes to avoid. Mistake number 1, mixing personal and business funds. Whatever you do, don't do it. Paying personal expenses with business funds is the definition of commingling, and it can actually completely destroy your liability protection. The solution is to always pay yourself first, then handle personal expenses from your personal account. Mistake number 2 is to ignore tax obligations. Failing to pay those estimated taxes or payroll taxes can add up very quickly. Not only can you end up paying fines, but you'll pay interest on everything that you owed. The solution is to set reminders, automate payments, and work with professionals to make sure you get it done. And watch out for this mistake: underpaying yourself. This is a big red flag for the IRS because paying yourself a very, very low salary so that you avoid more of the self-employment tax can really tip off the IRS, and you could end up under scrutiny. The simple solution here is just to make sure and research what somebody in your role would get paid under a reasonable salary. The last thing you want is Uncle Sam knocking on your door asking you questions you're not ready to answer. Okay, so here's your checklist. Number 1, LLCs offer asset protection, not tax savings. They do a great job of separating your personal and your business assets, but the IRS defaults your LLC to normally being pass-through tax treatment. Number 2, pay yourself by owner's draw if you're being taxed as a sole proprietor. This provides you the most flexibility, but don't forget to set aside those payments for taxes. Number 3, consider S corporation status once your profits really start to increase. It typically starts to make sense to consider when your net income exceeds $40,000 to $50,000. Number 4, if you choose an S Corp, don't forget to pay yourself a reasonable salary. Always balance between salary, where you do pay payroll taxes, and owner's distributions where you don't. Number 5, always keep your books, always stay compliant, and always consult with a CPA and an attorney. Understanding how to pay yourself from your LLC isn't just about avoiding these penalties or the IRS. It's really about setting yourself up to be positioned for financial success as you run your business. By setting up your business correctly and knowing when to elect that S corporation status, it's all about working smart, not just hard. I want to help you with this process if you are a rental property owner. Look down in the description below and you'll notice a link where I'm going to provide you a resource that will help you get started with your LLCs to help protect your properties. And if you need help finding a good CPA, a good bookkeeper who will actually help you get things together and get you organized, don't hesitate to reach out to the link below. Speaking of protecting your assets, how do you protect yourself from greedy lawyers who want to take your rental property and keep it for themselves because someone claims they got hurt on your property? Check out this next video where I explain exactly how you can stop greedy lawyers dead in their tracks to protect your rental property and your cash flow. See you over there.